Welcome to today's Explainer. We're unpacking a serious paradox in today's economic snapshot from July 14th, 2026. It's a completely fascinating, honestly kind of contradictory picture. We're looking at record tech-driven growth forecasts that point to an absolute economic boom. But that optimism is colliding head-on with a truly brutal stock market crash. So how can an economy look so amazing on paper, yet completely sink in the markets? That is exactly what we're going to decode today, using the actual data directly from the sources.
Here is a quick look at our agenda. 1. The 3.0% growth surprise. 2. Kospi plunging below 7,000. And 3. The 800 trillion super budget. Along the way, we'll also master the essential vocabulary used by the pros in global financial reporting. Let's get right into it.
Section 1. The 3.0% growth surprise. Let's start with some wildly optimistic news. The South Korean government just sharply upgraded its 2026 economic growth forecast to 3.0%. Now, context is absolutely crucial here, guys. That is a full percentage point jump from their earlier estimate, which was sitting at just 2.0%. In the world of national economic forecasting, a sudden 1% jump for a developed economy, that's massive. It completely flips the fiscal narrative for the entire year. To really understand global financial media, you have to look at the exact language they use. You're going to see the terms upgrade and economic growth outlook a lot here. Think about when you upgrade your phone, right? You get a better version. It's the exact same in finance. An upgrade means the government officially raises its projections. So when you see a headline saying a country upgraded its economic growth outlook, they're officially betting on a much stronger, more prosperous year than they initially thought. Now, you might be wondering, where is this massive upgrade actually coming from? Well, it certainly doesn't just appear out of thin air. It is almost entirely driven by an unprecedented global supercycle. We're talking about a massive export boom in semiconductors and just explosive growth in AI infrastructure. The whole world is hungry for processing power right now, and the domestic tech sector is positioned perfectly to catch that wave. To capture the sheer scale of this, analysts love to use specific phrasing. They use the terms driven by and unprecedented. Driven by is the perfect way to point directly to the engine of this growth. The tech sector is literally driving the rest of the numbers up. And unprecedented, that means we literally haven't seen a cycle quite like this before. It just highlights how historic and powerful this current tech export cycle really is. But here is where things get really complicated. We have a stark divergence going on. Yes, on one hand, the tech sector, semiconductors, and AI is absolutely booming. But on the flip side, we see the broader reality. The government actually had to lower its employment forecast. Why? Because of a really sluggish construction sector, plus those prolonged tensions in the Middle East are dragging down other industries. So it's basically an economy split right down the middle. You got this hypercharged tech sector masking a really sluggish broader job market. For the average worker, the flashy headline numbers might not match their reality at all. Which brings us to the glaring paradox of the day. If the overall growth outlook was just upgraded so significantly and tech is booming, why on earth is the stock market collapsing? Let's turn to our second major headline to find out. Section 2. Kospi plunges below 7,000. All right, let's look at the devastating Black Monday aftershock. The domestic market suffered a massive blow today. The benchmark Kospi index plummeted by nearly 9%, crashing right past the 7,000-point threshold. Let me tell you, a 9% drop in a major national index in a single day is a historic bloodbath. Billions in value just wiped out in a matter of hours. When reporting on this kind of devastation, global media doesn't just say the market fell. They say the index plummeted. That means falling incredibly fast, like a rock dropping from the sky. And they'll mention it crashed past a threshold. A threshold is a boundary, right? And it's often a deep psychological one for investors. Breaking that 7,000-point threshold means the market didn't just lose value. It broke through a major psychological floor, causing widespread panic. And here is the real irony. It was actually the heavyweights that dragged the entire market down. The very same semiconductor giants driving the economic upgrade were the ones getting absolutely hammered. Samsung Electronics shed roughly 10% of its value, and SK Hynix dropped a staggering 15%. You'll hear financial reporters note that the domestic market suffered a massive blow as the benchmark Kospi index failed to hold its ground. A benchmark is your standard, your main point of reference. When the benchmark suffers a massive blow, it means that pain isn't just isolated to a few risky stocks.
It's systemic. The core foundation of the market took a direct, devastating hit. So, what actually caused this? This steep sell-off was directly triggered by a trifecta of pain. First, deteriorating global sentiment. Investors worldwide are just getting incredibly nervous. Second, surging oil prices tied directly to those geopolitical risks in the Middle East we talked about. And third, aggressive selling by foreign investors who are pulling their capital out to find safer harbors. All of those global fears completely overshadowed the local tech boom.
Section 3, the 800 trillion super budget.
So, how does the government plan to bridge this wild gap between a booming export forecast and a crashing stock market? Well, the answer they've landed on is massive fiscal expansion. The government is currently drafting a super budget for 2027. And the numbers being floated are huge. It is expected to exceed 800 trillion won, often referred to in the press as 800 trillion plus alpha. When you're reading the international financial press, you'll see headlines stating that the government is drafting a massive super budget. To draft means they are actively writing and planning it out. And super budget? That isn't a strict economic term. It's a media phrase used to describe historically large, record-breaking government spending designed to shock the economy back into stability. To put that 800 trillion won figure into perspective, we're talking about a fiscal expansion of at least 10% from the previous year. That is a massive injection of capital from the state. They are heavily expanding the government's role in the economy to try and force growth beyond just the tech sector. Global investors tracking this will read that this new government budget is expected to exceed all previous records. Is expected to is a standard phrase pointing to a high-probability future event, and exceed simply means to go beyond the limit. They are literally pushing the limits of national spending to combat this market instability. The core strategy here breaks down into a clear two-step process. Step 1, collect all those highly projected corporate tax revenues generated by the booming chip sector we talked about at the beginning. Step 2, take that money and aggressively reinvest it straight into national AI golden time projects and bolstering semiconductor supply chains. They're basically taxing the boom to fund the future, hoping the wealth eventually trickles down to the struggling parts of the economy, like construction and local jobs. Which brings us to the end of today's explainer and leaves us with a really critical, unresolved question. The government is essentially doubling down, right? They're taking the profits from the tech boom and pouring them right back into the tech sector through this super budget. But will this massive fiscal gamble truly fix the stark divergence we're seeing? Can a booming AI and semiconductor industry eventually pull up a sluggish domestic job market? Or will the stock market's panic prove to be a more accurate predictor of our economic future? It is a high-stakes balancing act, for sure, and one we'll be watching very closely. Thanks for joining me today, and keep your eyes on the data.